One of the most important skills in Chapter 2 is to master the rules for debits and credits. And what I'm going to do is introduce something I call the Master T account. It combines all of the rules for assets, liabilities, and equity into a single T account. And I'd like you to practice drawing this T account out yourself until all the rules make perfect sense. What I'd like you to do is to draw out a T. Put the equal sign at the top of the intersection of the T, and then complete the accounting equation, putting the word assets to the left-hand side of the equal sign and liabilities and owner's equity to the right. And this is going to be a very visual process. The location of an item in the accounting equation is going to determine the side, the debit or credit, that results in an increase. Assets sit on the left-hand side of the equation. Assets increase on the left. Assets increase with debits and decrease with credits. Liabilities sit on the right-hand side of the equation. Liabilities increase on the right with credits and decrease on the left with debits. Owner's equity sits on the right-hand side of the equation. Owner's equity increases on the right with credits and decreases on the left with debits. Owner's equity has 4 subsets. 2 of the 4 items result in increases to owner's equity. Revenues show increases to owner's equity on the income statement. Investments show increases to owner's equity on the statement of owner's equity. Withdrawals show decreases to owner's equity on the statement of owner's equity. And expenses show decreases to owner's equity on the income statement. So we have 4 subsets of owner's equity. Revenues and investments are always and only credits, as their purpose is always and only to increase equity. Expenses and drawing are always and only debits, as their purpose is always and only to decrease equity. And here's an acronym for you to remember the 4 subsets of equity. The word RIDE. R, revenues, I, investments, D, drawing, and E, expenses. Revenues, investments, drawing, and expenses are all subsets of equity and follow the rules for equity. Increases are credits, revenues and investments. Decreases to equity are debits, drawing and expenses. So now let's use this information to solve exercise 6. There's our Master T account, and letter A says that during October, Alcorn Company had $83,750 of cash receipts and $84,588 of cash disbursements. The October 31st cash balance was $14,211. Determine how much cash the company had at the close of business on September 30th, the beginning of the month balance. So letter A is talking about an asset, cash. Assets sit on the left-hand side of the equation. They have a normal debit balance. Increases to assets are debits. Decreases to assets are credits, leaving us with a normal ending balance of a debit. So for the cash account, we're looking for the beginning balance. We're told that we had cash receipts, increases to cash of $83,750, and cash disbursements, decreases to assets of $84,588, and an ending cash balance of $14,211. When we set this up as an equation, B, the beginning balance, plus $83,750 minus $84,588 equals $14,211. When we combine the $83,750 and the negative $84,588, we have B minus $838 equals $14,211. We add $838 to each side, gives us B equals $15,049. The beginning balance is $15,049. Letter B. On September 30th, Mortgage Company had a $76,750 balance in accounts receivable. During October, the company collected $69,996 from its credit customers. The October 31st balance in accounts receivable was $79,129. Determine the amount of sales on account that occurred in October. Accounts receivable is another asset. The normal balance for all assets is a debit. This makes sense as assets sit on the left-hand side of the equation. Assets increase with debits and decrease with credits, and have a normal ending balance of a debit. The beginning balance in accounts receivable was a debit balance of $76,750. We're looking for sales on account. Every time we have a new sale on account, we increase the asset balance accounts receivable. And we decrease accounts receivable for $69,996, the amount of cash collected from the credit customers. Gives us an ending balance of $79,129. Our equation becomes $76,750 plus S, the sales on account, minus $69,996 equals $79,129. When we combine the $76,750 and the negative $69,996, we have $6,754 plus S equals $79,129. We subtract $6,754 from each side, gives us S, sales on account, of $72,375. Remember that accounts receivable is the amount owed to us by our credit customers. We debit accounts receivable when we start billing our customers, as we have here for the new sales on account, and we credit accounts receivable when we stop billing our customers, when they pay us the $69,996. Letter C. Strong Company had $152,000 of accounts payable on September 30th and $141,208 on October 31st. Total purchases on account during October were $279,224. Determine how much cash was paid on accounts payable during October. Liabilities sit on the right-hand side of the equation. They have a normal credit balance. The beginning balance in a liability account should be a credit. Increases to liabilities are credits. Decreases to liabilities are debits. And this makes sense. Since liabilities sit on the right, they increase on the right and decrease on the left, leaving us with a normal ending credit balance. When we look at the detail of accounts payable, the beginning balance in accounts payable was $152,000. We had new purchases on account of $279,224. This would increase the amount that's payable to our vendors. We're looking for the amount that was paid on account that would result in an ending balance of $141,208. Our equation becomes $152,000 plus $279,224 minus P, the payments on account, equals $141,208. When we combine the $152,000 and the $279,224, we have $431,224 minus P equals $141,208. When we subtract $431,224 from each side, we have negative P equals negative $290,016. P equals $290,016. The amount of payments on account were $290,016.